record. All right. So today our main topic is 5 different life insurance because a lot of us, the first license we got is insurance license. So today I will go over, different type of insurance and how it involved, because insurance, in fact, is something 90% of people don't understand, including myself. I did not understand it either. Okay, so, don't know how to choose, what are the choices, right? So let me start to share with my Elmo. Okay, so if you have the book, okay, so most of us, we have this book, right? It's called Saving Your Future book. Okay, so make sure you grab the book with you so that you can follow me. So I want to start on page 24, which is a concept of X curve, right? So refresh. So there are 2 curves in our life. One is wealth curve. The other is responsibility curve. Okay, so we want to grow our wealth. When we get older and older, we have more money, more wealth. Also, when we're young, we have a lot of responsibility. Okay, so that's why we feel less secure. Those responsibility, including our children, our mortgage, right? And the college cost and any debt we have. So if anything happened to us, let's say we're sick or disabled or even die, right? Who can take care of those responsibilities for us? And that's why we need to rely on the insurance. Okay, so let me refocus my things. Okay, I think that's a little better. Okay. So that is why everybody, right, need to have life insurance. So, but when we talking about life insurance, how to choose, okay, and how to buy. So I want to start with go to page 33, how to buy life insurance. Okay, so life insurance, when you buy it, just like when you buy anything else, when you buy sugar, you buy by pound, right? You buy gasoline, you buy by gallon, okay? So this called a unit, okay? Or you buy eggs, okay? Each dozen is a unit. So life insurance also, we buy it by unit. Each unit is 1,000 coverage, okay? 1,000 protection. Then each unit have a price, just like a gas, each gallon, right? So right now, maybe $6. Okay, so that's a price per unit. And life insurance also have a price per unit, which is called cost of insurance, which means every 1,000 protection, how much it will cost. So this cost will change with age. If you turn to next page, page 34. Page 34, you can see as age getting older and older, the price will also go up. So why is that? It's because of cost of insurance is state government, okay, decide based on mortality table. Means at every different age, how many percentage of people die, okay? If this percentage is high, of course, the cost will be high. If this percentage is low, okay, then this cost will be low, right? Makes sense, because when we get older, right, chances of we dying, okay, is higher. That is why cost getting higher. So I am going to start from there. Okay, I'm gonna use, okay, presentation with typically 5 circle to explain 5 different life insurance. Okay, so I'm gonna draw a line like this. Okay, so this is a curve of insurance cost, and each of this line represent the cost of insurance at different age. Okay, so let's say it's like this, because the age getting older, the price getting higher, right? So of course, when we're newborn baby, there's a little peak, and then 15, 16 years old, there's another peak, because, right, the chances of dying of die is slightly peaked when newborn, or 16 when kids just start to drive. But the rest of the time, you can see as age getting older and older, the price of insurance, cost of insurance just getting higher and higher. So the first type of insurance, okay, and people tend to buy, right, or people knew about, I'm going to use different pen, is called term. Term is a temporary insurance. Okay, if you look at the book, go back to the book, page 35, talk about the term insurance. Term insurance, right? The many different types, such as annual renewable term. For example, when you work at a corporate, and that insurance you renew every year. So every November you sign up corporate benefit, right? Employee benefit, and including your life insurance. But then next year you're gonna do it again. So that price is renewed every single year. Okay, so that's annual renewable term. So that is why you see the price change every year. There are also some other term you can buy every 5 year, 10 year, 20 year. Longest is a 30 year. Longest you can buy is 30 year. So during that time, the price will not change. And that price is average. Okay, so let me use this chart just to explain how it works. Let's say this is age 30. Okay, age 30, 40, 50, 60, 70. Okay, let's say this is the age. So if at age 30, I want to buy a 10-year term, basically they put a 30 all the way through 40. This 10 years insurance cost, they add up and then divided by 10. Then they will tell you if you want to buy 10-year term, this will be the price. But if you want to buy 20-year term, then need to cover from 30 to 50. So basically they add up all this 20 years of cost, okay, and then divided by 20, then they will tell you this is average, okay, annual cost, okay, you pay for this 20 years. If you want to buy 30 years, okay, there will be 30 all the way till 60. So then this will be the average cost if you buy a 30-year term. So you can see that that is why term insurance, if longer the period you cover, the higher the price. Okay, so that is the term. Okay, so I'm going to draw the first one, term insurance. Okay. So term insurance actually started around 1850s, the longest, right? So longest history. Okay. So because many people just worry, if I die, I want my family get some protection. If you look at, each insurance, we're going to compare two things. Premium, how we pay the premium, and do we have cash value? So if you look at term, this premium you pay is fixed, okay? Always, every year you pay the same. If any of the year you miss the payment, any of the months you miss the payment, then you will lose this policy. Your policy lapse, okay? Because, right, so there's just no flexibility on it. So premium is fixed. And cash value, no cash value. Term insurance is like a car insurance or like rent a house. Okay, when you're renting, you pay it, you have it, but that house does not belong to you. So there's no cash value, nothing belongs to you. And also after the term expire, let's say after 30 years at age 60, okay, and this basically your term expire, you want to buy again, you're going to look at the next 30 years. Okay, you're going to look at 60, 70, 80, right? Following years. Okay, so if you want to buy 10 years, the price might be here. You want to be 20-year, price might be here. 30 years, right? So price can go much higher. Okay, and also given you are still insurable, you did not have any heart attack or cancer or something like that. So if you don't buy, then you die after 60, then no death benefit. Okay, because they will only pay you if you die during this period. So chances are, in fact, only 2% of the population die during the period. So which means 98% of people, all the premium they paid is gone. They did not get anything back. Okay, so that is a term insurance, but it's very cheap and affordable. Okay, it's for people, right, have very, very tight budget. They can still get term insurance. So that is why later on people say, well, I want to have a guaranteed death benefit. I don't want to later on expire. Just like one of the client or I have in New York, of course, I got a permanent insurance for her. But one of her previous term, she missed a payment just because of the pandemic. the shipping delayed. So her envelope arrived 2 days late. Okay, so that company, the insurance company, canceled her policy. Okay, she was already 55 and she just diagnosed a serious sickness, so she cannot get proof anymore. So when she lost it, she lost it. Okay, so that term insurance is gone. So everyone want to have a permanent protection, right? I don't want the protection for my family, right? Is expired. What if I die at 70, 80 or after that? So then the second type came out called whole life. So what is a whole life? Okay, so whole life works like this. Okay, I'm going to use a different color again. So let's say at age 30, I want to cover my whole life, means cover all the way till 100 years old. So whole life say, yes, I can cover you whole life, but I will require you pay much higher. So you will pay at this amount. So there will be whole life payment. So you pay more. So you can see the actual insurance cost, right? So it's much less, but you pay more than that. So this is the cost of insurance. You pay more than that, and then those additional premium you put in, they will give you an interest, which is become your cash value. And that cash value gonna pay for your future life insurance so that they can cover you all the way till 100. If you look at the book, there will be page 37. Page 37, you can see, so this explains what is a whole life. Whole life is original and also oldest form of cash value life insurance. Okay, so instead of paying just the cost of insurance, you pay higher premium. You pay higher, and then the difference between the premium and the cost goes to your cash value, and they give you a guaranteed rate of interest. So just like this one, you see, right? So you give more money than the cost of insurance, and then the additional money, they give you an interest to pay, okay, the future cost of insurance. So this is how whole life looks like. So we also will compare the two things of whole life, premium and cash value. Okay, so if you look at the premium, whole life premium also is fixed. You cannot mix it. You cannot miss a payment. You miss a payment, you lose your policy. Okay, no flexibility. And you continue to pay for your whole life. Okay, another meaning of the whole life, the premium need to be continued whole life. And then it does have cash value. So this cash value, how they calculate the interest rate, they give you a fixed interest rate, typically 4%. Sometimes they say, I also give you a dividend if our company is very profitable. So in fact, that so-called dividend is overpaid premium. The insurance industry have a regulation. So your profit margin cannot be higher than certain point. If your profit margin is higher, you have to refund the consumer. You cannot keep that money. You have to pay back. So that's actually the dividend. When they have a dividend, means the company overcharged you. Okay, they will tell you, I either give it back to you or you reinvest. Okay, right? I put in your account for you. Okay, so that's so-called dividend. And also dividend, it depends, right? So may not have it, right? Typically give you 4%. So that is a whole life. And also this cash value, not designed for you to use, because if you take the cash value out, they don't guarantee your death benefit anymore. Okay, so whole life, the key feature of whole life is guaranteed death benefit if you don't touch your cash value. So that's it, right? So whole life is mainly designed for death benefit, not living benefit. So it is good for people maybe after 65 or after 70 years old. Then they just want to have a death benefit transfer to the next generation. Then whole life, okay, can be a good solution. So no matter term life, right, or whole life, so they all have to be according to the mortality table, the cost of insurance. So whole life started around 1900, okay? Then something happened in the United States history around 1977, okay? So a new tax code came out called 401k. So before 401k in United States, people have a pension When they retire, the government are gonna give you income, salary. You don't have to worry. So before that, nobody cared about investment. But when 401k come out, United States retirement shifted from defined benefit to defined contribution. Means in the past, you know how much benefit you're gonna get when you retire, but now you don't, because 401k depends on what investment. You might lose all the money, but you do know how much you can contribute. So it's called the defined contribution system. So from then on, right, basically, right, family are required, you have to understand investment because you manage your own investment now. So then, you know, all the consumers start to look, let this one 4%, that's really low, right? The investment rate is really low because that time, the bank interest rate, you think about people come to United States around 1980, right? The bank interest rate can give you 17, right? 18%, 14%, just when you open a checking account. When you get a mortgage rate is 18%. So then people look at this, you only give me 4%. Why I want to invest here? I would rather put money in the bank. Bank give me 14%. So that is when our company started a slogan called buy term, invest the difference. Okay, because this difference I can put in the bank and I even get more than 4%. Okay, why I want to buy whole life? I just buy term and I invest by myself. So insurance industry wanted to attract investors. So they developed a third solution, okay, around 1980s. So right after 401k, okay? So they developed a solution called universal life. So let's take a look at what is universal life. So look at page 39. Page 39, okay, the universal life. The difference between the universal life and the whole life is flexibility, okay? So you can change your premium. So every month or every year, okay, you can pay more one month, you can pay less next month. Sometimes when you face money problem, you can even skip a few payments as long as the cash value inside the policy is enough to pay the cost of insurance. So you can pay more, you can pay less, and you can skip. Okay, so it's very, very flexible, right? Not like a whole life, you have to pay all the time. Also, you can adjust your death benefit as well. Okay, let's say later on, I getting older, I don't need that much life insurance anymore. My kids grow up. I can actually reduce that death benefit as well. So you have a lot of flexibility. So if you look at the chart down here, okay, so it's a flexible premium. Not like a whole life, it's a flat line, you always pay the same. And now you can be very flexible how much you pay into it. So that is why it called, so it's universal. Whenever you see universal, then you know what mean is flexibility. Okay, so now, so we compare every insurance, right? Two different things, premium and cash value. Okay, so universal life, also any life insurance with cash value is a permanent life insurance. Okay, so this is a permanent life insurance as well. If you look at the premium, right? So anytime you see this universal, that means this premium is flexible. Okay, you can put more into it, you can put less into it. Okay, you can skip if you want to, it's flexible. But what about my cash value? How they calculate my interest rate instead of a whole life is a fixed interest rate. Now, universal life said the interest rate I'm gonna float with the bank. Okay, if the bank interest high, let's say bank give you 10%, I'm gonna give you 12%. I give you higher than the bank. Bank give you 12, right? Give you 14. So I always slightly higher than the bank interest rate. So cash value, the interest rate will be floating rate with the bank, floating. Okay, so of course, when the bank interest rate was 10, 12, and this solution was awesome because people can run illustration with a 14 return. It's very good. But nowadays, right, we all know bank interest rate almost nothing. Okay, 0. So now this maybe only give you 3% return, not as high as before. That is why many people purchased universal life before, but they didn't fund it very well. They didn't put enough money. So the policy might lapse when they turn to 90 years old because they didn't fund it enough and interest rate not. Yes, Wesley, have a question? You're muted.
Real quick, I think is it true the interest rate for whole life and universal life, as those are guaranteed?
So the whole life interest rate is guaranteed.
Okay.
Okay. Yeah. And so universal life, okay, so it's not guaranteed. It's only maybe have a minimum, let's say at least 0, but no guarantee how much interest rate gonna be.
Oh, okay.
But the whole life, it will be guaranteed, let's say 4%, 4%, 4%, always guaranteed.
Okay.
Okay.
Okay, thank you.
Sure. Okay, so so after universal life, okay, what happened in the market is the stock market shooting up, right, at around 1990s. So all the people buy stocks, okay, their investment grow crazy, just like the past 12 years, every year 20%. So, you know, many people tend to go to invest in the mutual fund stocks. So insurance industry wanted to attract, okay, investors. So again, they also develop third, okay, type of permanent insurance, okay, called variable universal life. So again, if you see this universal, that means the premium is very flexible. Okay, you can put more, you can put less. Okay, so how much you want to put in is up to you. It's very flexible. So what about the cash value part? So this investment, since so many people like stock market, so insurance companies say, I can also let you invest in the equity, which is mutual fund. You can invest mutual funds with your money in the insurance. Okay, so, but insurance company is not allowed to do any risky investments such as stocks, mutual fund, not allowed, because that's insurance company. Insurance company can only do fixed income, right? Guaranteed. So what they do is insurance company collaborate with a mutual fund company. So these two companies work together. So your insurance account have a sub account. That is sub account money going to the mutual fund. Okay, and that mutual fund you choose from that mutual fund company, right? You can choose whatever you want. So at the beginning, of course, it's good, right? So 90s, the stock market keep growing, everybody's happy. But then everyone know what happened, right? Around 2000 to 2003, which is 911, okay? An internet bubble burst, and a Y2K, right? 3 years, market go downturn. And finally, the market start to come up again, then 2007, 2008, then that's another great recession. Housing market meltdown, okay, another 56% drop. So many people lost their money in the cash value because just like a 401k, you lose money too. But people don't understand, how come it's an insurance product? How come I lose my money? So they start to blame the company, they blame the agent. So sometimes it's because the agent didn't explain very well, also because the consumer don't know how to use it. Because if market crash, you probably want to add more money, right, into it instead of cancel. But many people cancel that policy. When they cancel, you lock in your loss. You lock in your loss and you pay a penalty, okay? Or because there's a surrender period. You cancel in less than 10 years, the surrender charge. So that is why many people bought this at that time and got very, very negative on life insurance because they were not educated to learn how to use this solution. In fact, the solution itself, okay, nothing wrong with it. And also the insurance cost also follow, okay, whatever insurance you got, okay, so insurance cost always follow the mortality table. So that is why around 2000 after, okay, Okay, so around 2000, there's a new solution came out. Okay, and the first product available on the market is 2005. And this is the most innovative solution called IUL. Okay, if you look at this evolving period, right? So just like iPhone, okay, something like iPhone at the beginning, just like a term, can only make phone call. Term only have protection, temporary protection. And then, right, iPhone start to add more function. You can check email, you can send message, right? Then you can use that GPS, you can play video, more and more function add in. Just like this iPhone evolved, right? Completely changed this industry. So did IUL in the financial industry. Okay, so IUL, first product available in 2005, okay, developed by Transamerica. And right, so nowadays, many insurance companies have IUL product. So what is IUL then? So again, since it has a U, okay, so that means the premium is flexible. Okay, whenever you see U, universal, okay, in the name, so that means the premium is very flexible. Okay, how you pay it? You can pay more, you can pay less, you can skip payment if you have to. But what about the cash value? Okay, this cash value calculation is very unique. So your money is not going to go to any mutual fund company. Stay with insurance company. Well, stay. Okay, stay with the insurance company, and this is how they will calculate your interest. So your return, okay, they will look at a public index. Okay, so public index. So, okay, so this is how you're going to calculate your interest rate. So let's say index this year, okay, actually grow for 6%. Then they will also give you same 6% interest rate. So this will be your return, okay, interest. If index this year negative loss, okay, just like 2007, 2008, then they will give you a minimum floor, minimum interest rate. Most of the time, at least give you 0. Sometimes they even give you more than 0, 0.5 even. And if the market grow very high, let's say 20%, they're also going to tell you, sorry, since I guarantee you never lose your money, I cannot match you that high. I will also have a maximum interest rate. Okay, let's say maybe maximum, I give you 9% or 10%. Okay, they can adjust based on the market. So you can see your return always going to have a minimum interest rate and also going to have maximum interest rate, your return. So, so now, since if the market crash, still guarantee I never lose money. So that will allow average investor can all invest now, because before, most of people cannot afford that loss, because if I money lose 50%, I cannot retire anymore. So now, but with this index strategy, my money guarantee never lose. So now everybody can invest, no matter you understand, you don't understand, you have time, you don't have time, everybody can do that. Okay, so you can have a peace of mind, just wait for your money to grow. Okay, so that is why index universal life becomes the most popular insurance, okay, life insurance. In all the newly applied life insurance, index universal life counted more than 70%. Okay, more than 70% in the application nowadays. And the term insurance today only count around 20% of market share. And the whole life today also only counted around, less than 20% share. Okay, majority of the permanent life insurance now go to index universal life. And not only that, there's another big, tax code announced during the history, and it makes universal life even more attractable. Okay, so instead of a 401k, this tax code came out in 1977. Another big tax code came out, okay, in 1986. So this tax code called Internal Revenue Code 7702. So what this tax code meant, okay, they had an amendment in 1987, okay, the new amendment. And this tax code have two key features. in it. First feature, they said all the investment you have in the life insurance is tax-free. So all the money you have, the capital gain you have, okay, you don't pay money, you don't pay tax. So now this totally changed the slogan we had in the past. In the past, people say we buy term, invest the difference. Maybe it's true because your investment might be getting higher. But now, because this tax code changed that, because no matter where else you invest, you have to pay tax. Okay, you have capital gain tax. You buy stocks, you have capital gain, pay tax. You buy a house, you sell the house, you have a gain, you pay tax, right? No matter what you do, you pay tax. But now this one become the biggest tax loophole. All the money you invested, you never pay tax. That's why we often call this rich people's Roth IRA. Okay, because a lot of high income, high net worth, right? You cannot qualify Roth IRA. You cannot get tax-free. But now with this, you can go tax-free, and yet you can load money. You can put a lot of money into it. Okay, become a huge tax loophole. All my investment tax-free. And then also second feature of this tax code, allow you loan your own cash value. So which means I can use my money. Why they call it a loan? Rich people love to do loan. Why? Because loan is tax-free as well. You know, when you get a loan, no matter it's a car loan, a mortgage, right? When you get a loan money, you never pay tax on it. So they call it a loan so that they can use this money, do not pay tax either. So now you make this solution. I can save money, I can grow my money, no tax. I can use this money, no tax either. I just loan it. I call it a loan so that it's tax-free. Okay, so that is why this tax code totally, right? Just the rich people lobby the Congress to pass. All the purpose is to avoid paying tax. That's all the rich people do every day, right? Just think about how can I avoid paying any tax. Okay, and plus, of course, life insurance, any life insurance, death benefit also tax-free. So that is why if you look at this, right, so 5 different life insurance, right, evolve in the history, right, just like iPhone, and also make the IUL today is like the powerful Swiss Army knife. Okay, it can do everything you want because you can invest your money gonna grow, and you can also have a safety. You don't worry about you losing your money. Plus, all the money you make, you don't pay tax, and you can access, it can be your emergency fund, right, at your tax shelter. You can use it for your retirement, tax-free income, so you do not pay tax. So that is why it becomes so powerful. But if you look at in the other category, we still have some people do need some other type. Okay, so I'm going to show you some examples. Okay, I'm going to show you real product examples. So each of this, we still have some right solution that can be appealing to customers. So let me explain first term. So even though right term, okay, so cannot guarantee you permanent, but for let's say somebody 45 and only make 50,000, 40,000 a year and have 3 kids, and wife doesn't work, the wife have to stay home taking care of 2 years old, 3 years old, 5 years old, right? And for this kind of family, we still need to help them get a term. But okay, so we want to have a good protection for this father, because let's say this father always drive let's say Uber Eat, okay, and might get very risky. So we have the best term in the market that can give living benefit. Many people don't know that. Okay, so let's say this person get $500,000 coverage, and also worry if I get sick or disabled, I want my family paid. Okay, so this is a Transamerica, this product called Transsector. Okay, let's say LB, like a living benefit, let's say 30, cover 30 years, okay? Age 45, let's say this person relatively healthy, I get $500,000 protection, okay? So with 3 living benefit, terminal illness, chronic illness, critical illness, because this family may not have any savings, no saving, live paycheck to paycheck. But they have 3 young kids, little babies need protection. Okay, so we can get this so that if the father is sick, disabled, so family gonna get living benefit, or he die, get $500,000. So just to show you, like terminal illness, let's say the doctor say this person definitely gonna die, even if we treat him, there's no use. Okay, then this $500,000, he might be able to get 462,000, even when he's still alive. Okay, the family can get this money, right? Can help their 3 little babies, right? So now, what if this person get the diagnosed chronic illness? Chronic illness, right? It won't kill him, but okay, so maybe, always have a back pain, always, cannot, maybe crippled, cannot walk very well. So then every year, this family can also get paid, depends on how serious is his sickness, maybe get 26,000 or 65,000 per year. Still gonna be a big help, right, for this family and the young kids, this chronic illness. Okay, so critical illness means he is sick. If we don't treat him, he's gonna die. But if we treat, okay, maybe he can still survive. Okay, that's a critical illness. So it depends on how critical it is, right? The family maybe get paid 100,000 or 245,000. So to get this kind of a solution, how much he need to pay that? Okay, so look at this page. So this page show you depends on how long you want the protection. LB10 means cover 10 years. LB20 means cover 20 years. LB30 means cover 30 years. So let's say he want to have a 30 years protection. Okay, he can choose less. So if he choose longest 30 years, the monthly pay will be $145. Okay, total each year will be $1,690. Right, so it's very affordable for him to pay $145 to get all this benefit. So let's see. Okay, so what kind of, okay, let me show you. We always have all the solutions, right? We have this we call 4-box. Okay, once you license, I will send you how to use this 4-box. So in this example, okay, so I'm going to show you in the 4-box. So this person is 45 years old, male, right? And okay, basically paying, okay, I'm going to draw this, paying $145.34 for 30 years. So total 30 years, he paid $50,700 total 30 years if he continue pay till he turns 75, right? 45, 30 years and becomes 75 years old. So basically can cover majority of his life. And with the protection, the death benefit, he get $500K. If he die, right, family can get that tax-free, $500,000. But what if terminal illness, right? Terminal illness, we saw that around 462,000. When family receive that, also tax-free. He might also have a critical chronic illness, depends on which one, right? And how much, maybe 100,000, maybe 50,000 a year. So when family receive that, also tax-free. And it's very affordable, right? Only $145 get $500,000 protection. Okay, $500,000 protection. So, and also is convertible. Let's say this person might join us, start to make money with us, and then he can make additional 5,000 a year. Then he said, oh I don't want a term anymore. I want a term permanent life insurance. And then he can convert to permanent life insurance with no medical exam. Okay, so this is what this term look like, right? We even with $145, he can get 30-year protection of $500,000 death benefit with other, protection. So this is the most appealing term insurance on the market. Okay, right? If you have any question, okay, you can speak out. Okay, so this is the term insurance suitable for people with a lot of responsibility but very low budget. Then let's talk about the whole life. Okay, so even though, right, whole life may not good for young people, but it is really good for older people, especially people, right, like I said, whole life is mainly just for guaranteed death benefit. And we also have a very good whole life policy, not only give death benefit, but also give you funeral planning. Okay, so because when people getting older, right, we always worry, what if we need to take care of, I just went to San Diego, and this lady, she actually got somebody homeless in her house, live with her. And this couple, right, so of course past the age now, they're 86. If they met me earlier, okay, they actually wanted this solution, wanted a funeral planning, okay, solution, because they worry, what if this person die, and what we're gonna do with the body, and how we're gonna send, right? So we have a solution like that. Okay, so let me show you this second one. So this one called Everest. Okay, Everest. Okay, so this is the funeral planning. So not only they give you the death benefit, so for example, the oldest age that people can buy is 85 years old. Okay, 85. After 85, that's why this person I met at San Diego, she want to buy. I said, how old are they? 86. Oh, I said, sorry, past age. Okay, you cannot buy it now, because the oldest we can sell is 85 years old. At the bottom, you see 85. Okay, so let's say somebody at 75. Okay, 75 probably should start to plan this, right? So for the funeral planning. 75, it typically like parents, like the children buy it for the parents. Okay, so 65, let's see. Okay, so now you pay certain amount, you can get, so on the top here, oh, this is smoker. Okay, I'm gonna move to the top. This is a male non-smoker. Okay, 85. Okay, so let's say you can 75 years old. On the first column is age, so you can pay $549.26 at 75, and you can get 50,000 death benefit, which is guaranteed, and immediate death benefit. Not only that, they do a lot of conscious, like such as they give you will, they do tensing, and they take care of everything. Yes, Tita, I have a question.
Is it only me that don't see the screen?
But you don't see the screen?
Yeah.
Anybody else don't see the screen?
We see it.
Okay.
You might need to swipe it.
Okay, all right.
You can swipe. Okay, swipe. Yeah.
Thank you.
Okay. So, and so this one basically is release my hassle, not only give me death benefit. Okay, so let me show you what other benefit it actually give you. So with this, let's say this person is 75, okay, 75 years old, okay, and get this funeral conscious, okay, service package, okay, which is a whole life, paying 500, okay, $549 a month for life, okay, because we don't know how much longer he will live, maybe 10 years, maybe 20 years, I don't know, right? But we manage the risk. So what he get, first get the protection. This is 50,000 death benefit will be paid out 48 hours. That's gonna cover the funeral cost, because most of the death benefit, right, of life insurance gonna take a few more days. You need to verify death certificate. When family may not get money right away, but the funeral cannot wait. Funeral service guy always want cash. You give me cash or give you service. You don't give me cash, no service. So now this one can give this family cash right away. Yes, Wesley.
Yeah, quick question. So is this similar, is it also an insurance product?
It's a whole life. Whole life.
Whole life. Okay.
Yeah, whole life.
So it still goes through the same qualification process, and then they will determine your monthly rate.
So this one actually very easy to qualify. No physical exam needed.
Oh, okay.
Just a quick 5 to 10 minutes phone call.
Okay.
And 95% of applicants get approved.
Okay.
Yeah, very, very easy to prove. Okay.
Thank you.
Yeah, you're welcome. So pay out very fast. And also the concierge. So you can call professional anywhere on the world. Let's say you're in Thailand in a vacation. You can call them, they will give you service there. Okay, or you're in Hawaii, okay, no matter where you are and no matter what time it happens, okay, always will be service available, okay, no matter where and no matter when. And also online planning, right? So unlimited storage. Let's say somebody have a recipe, picture, video, they want to store somewhere to keep for the next generation. Also want to have a will, okay, and wishes, okay, my will, my living will, what kind of flower, where I want to be buried and whatever, okay, they also offer the will, okay, you can provide, you can have that will included. So this all included in one package, okay? So this is an example of whole life can have some very good solution for family as well. Okay, and then, okay, let's go to the last one, okay? Oh yeah, VUL, I may not go to much detail about the VUL. So VUL, so this just, maybe I'll go to IUL first, okay? Let's say IUL. So somebody 45, okay, there's somebody 45 years old, okay. So IUL, let me give you two examples. So let's say same 45 years old, okay, as when we explain the term. The term he pay this father, right, pay $145 a month, get $500,000, right? But what if this is a family actually have quite a bit saving, or every year they can save good amount from income. Okay, for the same $500,000, he can choose and maximize, putting $37,863 a year. Okay, and then 5 years payment, done with it. Just pay 5 years. And just like buying a house, now you 5 years, you buy this $500,000 house. Okay, 5 years payment, you total putting 166,000. You own this $500,000 house. So that's almost right. That's about 1, 2, 3 already. 1, 2, 3 investment return. $1 becomes $3 already guaranteed there, because that $500,000 is gonna be no matter when, right? My family gonna get at least $500,000, but you might get more than $500,000 as well. Okay, so let me fast forward. Fast forward here. So now you can see at age 70, you can see your own cash value, the second to the last, already more than $500,000. Your death benefit already become 583,000, become higher. And now you can use it for your retirement. So this become your retirement income. Let's say I want to take my retirement money out for the same amount. Let's say I choose to take the same amount of money out. So every year I take out 39,674. So that will be a good retirement income for me, right? Because, right, so that's more than 3,000 a month tax-free income. Tax-free is like after tax salary, I bring home 40,000 a year. And I continue to take it out every single year, take the same amount of 40,000 until I die at 90 years old. I take out almost 800,000 now. So not just $500,000. I take out 800,000. Why? Because I chose to add more money early. Okay, my money can compounding growing in this solution. So even I die at that time, I still have 144,000. Okay, so last column, that's as my death benefit. So now look at this solution, right? What it looks like, okay? What kind of a benefit I get. So as I mentioned, this is the most powerful, most popular life insurance because it has so many different functions in it. So what kind of function? Okay, let me show you. So here, in this example, okay, so this example, again, we're going to show what you pay and what you get. So what do you pay? So this person, right, this person pay 33,000, okay, a year, right, maximum saving, okay, try to save very fast. And okay, so then also total just save 4.5 years, okay, then after that never save again. So total putting 166,000, just 4.5 years, done. And what he get 4 things. First, the money gonna grow It's gonna grow with index options. Whatever index you choose, S&P 500 grow, and you're gonna grow the same. And safety, they're gonna have a guaranteed minimum interest rate. In this example, this even market crash, you still get 0.5%. And growth, they can grow up to 9% interest rate. And biggest one is tax advantage, right? The death benefit, this one has $500,000. If let's say second year I die and the family get $500,000 tax-free. And also I can access this cash value tax-free as well. So we just saw earlier at the age 70, I start to have more than $500,000. Okay, more than $500,000 cash value I can use. I can use it for my income, retirement income. Every year I take out almost $40,000, $39,672 for 20 years. So I take out $793,000 tax-free income. Okay, so that's just, you think about 166,000, now give me 793,000 tax-free income. And now I also get a protection, because if something happened to me, my family get $500,000, that's also tax-free. Or if I die at age 90, after I take out 793,000, I still have 144,000 tax-free money left for my family. So this is an example. I maximize my investment at the beginning, because I happen to have some money sitting in the bank, and I can save a lot from my salary. But what if this family say, I don't have that money, okay, but I can try to save a few $100 from my salary, okay, then we can choose second payment plan. Let's say this person say, I can pay $900, okay? So this example. So you can see this example, same age, 45 years old, 45, okay, $500,000. And this person say, I'm gonna save a few $100, okay? I will try my best, save $900, because I understand this is investment for my own retirement. I wanna add more money. So in this scenario, I said, your money gonna grow slower. I would suggest add a long-term care rider on it, in case you need the money, right? But you don't have much saving, and this can take care of your long-term care. Add the long-term care rider. So add some protection so that you won't, when that happens, you will exhaust all your savings. So in this scenario, you see the first column, $900 a month, every year is $10,800. Continue, right? So, you know, continue, let's say save all the way to 65 years old. Total putting 216,000. Okay, now if you look at the example, okay, at age 70, he won't have more than $500,000 now, because he didn't put as fast as the first one. So in this scenario, he will have 76,000. Okay, little less, but it's still good amount, right? And if he start to retire, he can take out $32,520. Okay, so he can still take a good amount of the money out, right? So a little less than 3,000 a month, tax-free money. So for 20 years, he can have 650K, okay, tax-free income. So still very good, and plus a long-term care protection. And at the age 90, if you look at age 90, he still can have 40,000, still have 40,000 and death benefit left. Okay, so if you look at this one, so, okay, again, I will use a 4 blocks to summarize. So with this payment, okay, plan, what he pay and what he get, okay? So now, so in this scenario, what he pay is $900 a month, and for 20 years, from 45 to 65. So total, he put in 216,000. So growth and safety is same. It's gonna grow with the index up to 9%, right? Safety minimum interest rate give you 0.5%. But the only difference is how much cash value, right? And death benefit is same, $500,000, okay, which is tax-free. And in this scenario, at age 70, the cash value he has is 376,000 instead of more than $500,000. And tax-free income is $32,520 a year for 20 years. So total, he take out $650,000 tax-free income. Okay. So the tax advantage, okay, still more, right? I put in 16,000, but I get out 650,000 tax-free money. Plus, I have protection, death benefit, $500,000, right? If that happens, my family get this tax-free. Or because we add a long-term care rider in this one, which is also $500,000 total, $500,000 long-term care rider. So if I need long-term care, this person will receive 10,000 cash per month until this $500,000 use up. So this family, even with limited budget, still can get protection, right? $500,000, long-term care protection, 10,000 a month, plus, right? And if he never use it, he can use it for retirement income. Okay, 650,000. So this is how the IUL works with growth potential, safe investment, give you huge tax advantage, right? And still give family a permanent protection. Okay, so I will conclude here and see anybody have any questions.